Hi everyone, this is Paul Cooper with Totes and Notes, and I'm bringing you a new series called Profits and Loss. And we're going to talk about some of these myths with the stock markets, investing in general, some of the so-called profits that are really large in the market and financial spheres that talk about what you should invest in, what you shouldn't invest in, some of the classical advice they give, why it may or may not be good. Before we get started, let's go over this brief disclaimer. I try to put it out there all the time. I'm not an attorney, CPA, or any time licensed professional advisor. Everything I say is basically just what I've experienced from my opinion. You need to get professional counseling. Don't just listen to me, or really don't listen to any one person. The topics we're going to discuss are basically just general education. Hopefully they're a little bit entertaining as well and you get something out of it. I hope you really enjoy this series. If you have any suggestions or questions about it, please don't hesitate to reach out to me and I'll try to address those. And make sure when you are investing that you do use caution and that you understand the investment. And always understand that there is no such thing as a risk-free investment or anything that should be guaranteed. So series topics and key points. We're going to talk a lot about buy and hold, since that's what a lot of people do. That's kind of the traditional investing model, especially for most people in the stock market and some other passive strategies. They can work, but here's the deal. They don't work all the time. Now, granted, no strategy for any type of investment always works. But the classic buy and hold for until you need to sell for retirement or whatever else, it's not a very good strategy. We're basically going to kill that sacred cow. And so pay attention to that and realize that if you do buy and hold, that's great. Just don't ever fall in love with any investment. You need to be prudent and realize that all things do eventually come to an end. One of the things that a lot of people disregard when they're quoting stock markets and buy and hold is that there are long periods of time where investors are losing money, or they're spending long periods of time getting back to where they were at. So if any of you remember this last stock market crash and the housing decline, the Great Recession of 07, 08 and onwards, yeah, it took a long time for us to get back to normal on that. If you've heard my other story about, I basically started investing in my self-directed IRA when I was 16. And then 10 years later, I'm in finishing up school and moving on. I go to check it. Nothing. Broke even the entire 10 years. So, which means I actually lost money due to inflation. So that's not good. Basically a decade worth of growth gone. The other thing a lot of people don't talk about is the sequence of returns is more important than the average of returns. So people will quote that you get 10% over the long haul in the stock market. Yeah, maybe, but how many large down cycles did you have to go through? And when did they happen? Did that down cycle happen, for me, when I was in my teens and early 20s where I can recover from it? Or is it happening when you're retiring and you can't afford that 50% decline because you're having to pull money out now to support your costs and your living expenses? So they don't talk about that. The other thing, time periods, they're really underappreciated and unrecognized. Oh, yeah, over the entire 100 plus years, 200 years, you'll hear this from Dave Ramsey and other gurus, and I have nothing against Dave Ramsey except this. I really like the guy. He's helped a lot of people. But they'll quote that, and Dave, that's over the entire stock market's lifespan. 200 years almost? Who here has that long to invest? Who here has 50 years to invest? Most people aren't going to have 50 years to invest because you're going to retire before then. So that's something you got to think about. And that brings us to portfolio and investor duration. How long can your portfolio stay invested in what it's invested? How long can you afford to have it invested there? And what are your tolerances? That's really what you need to focus on, because that'll help determine what you should and shouldn't invest in, whether that's stocks, bonds, real estate, something else, or a combination of them. And then, everyone's talking about, compounding. And Albert Einstein's often attributed the quote that, compounding interest is the most powerful force in the universe. That doesn't work when there are large losses, again, because we don't have that long of a time frame. So if you lose 50%, it doesn't matter if you're making 10% year over year on average. Those 50% declines kill that, and it takes you forever to get back to break even, so you're really not compounding. in the long run. And then what other people won't talk about is there are periods of time where more risk-free investments like treasury bonds and other things that are more secured, they may pay lower rates on average because they are more secured. There are lots of periods of times where they're actually on par or doing better than the equity markets. So, again, if you have a large decline, it's like, oh, well, I can only make 2 to 4% maybe with a treasury bond. Well, that's a lot better than losing 30, isn't it? Again, stock market's not the end all be all. And there is no investment that should be your end all be all. You probably should have a more diversified portfolio across assets. But again, most people out there, when you talk to them about their retirement accounts or investing, they're talking stock market. Investor psychology plays a huge role in returns. Can you go against the herd? Can you stay in when it's bleeding, and can you buy when there's blood in the streets? Can you not sell when it starts swinging up and you've been hurting for so long? Can you hold out for the maximum profits? The other thing with investor psychology is you can do your homework and you can invest in the right company, the right asset class, especially in equities, and make all the right decisions, but you really can't influence it. There can be some outside influence. If there are enough people selling it, it'll make the prices go down. If enough people perceive it as a sale, as either being bad or it's a good time to sell, then they can control it even though you could technically be right. So again, investor psychology, it can work against you, and you need to be able to withstand those periods and recognize what's going on, and then also recognize a lot of it's out of your control. And finally, hopefully throughout this series, we'll help you figure out how do you achieve long-term returns and achieve your financial goals, because that's what we're all here for. I mean, most of us aren't investing in the stock market or the Wall Street casino because we view it as gambling and want it to be like gambling. If we want to do that, most of us would rather just go to Vegas or something else. So let's hopefully dispel some of these myths and help you get your investments on track to where it's not like gambling, and you at least are a more educated individual. So when you do seek out these professionals for counsel, you can ask better questions and hopefully get to where you need to be faster. And now part 1 is called Buy and Hold Can Be Hazardous to Your Wealth. And I'm going to have to give some credit out here. I'm going to talk about a gentleman here in a little bit. He wrote some really nice articles on Zero Hedge about a year ago. And my video series is going to parallel a lot of what he says and use a lot of his information. And this title here was almost too good for me not to completely rip off. So I'm going to give credit to credit's due, and I'll give you his information here shortly. And we'll talk about his website. It has some phenomenal investment articles on there and just general investing advice. But before we get to that, we're going to talk about the Oracle of Omaha, since he's going to be our prophet for this week. Now, I'm sure all of you have heard about him. Warren Buffett's is probably one of the best, if not the best, stock investor ever. One of the richest men in the world, if he's not currently still the richest man in the world. He owns a company called Berkshire Hathaway that's had just phenomenal returns the past few decades. People will buy one share of stock from his company, and usually it's pretty expensive. I believe a lot of times it's in the high hundreds or low thousands. They'll buy one share of stock just so they can go visit the Berkshire Hathaway meeting in Omaha each year, because they have such phenomenal investment advice and so many good people there that can give, basically, instead of the State of the Union on the country, they're giving the State of the Union on the investments. So very, very popular, and has a very loyal fan base. I don't like all of his investments. He constantly advocates basically the traditional buy and hold, look for good growth companies and buy them and then hold them for long periods of time, which can be good if you know which companies to buy. But again, you're probably not going to hold anything, or definitely shouldn't hold anything forever. The thing I don't like about Warren Buffett with some of his investing is he talks and lectures people about saving and what they should do with their investments and what they should invest in. And then he goes out and gets the U.S. government to back him up on so many investments. So he basically gets paid from the taxpayers on a lot of stuff. He's made a just insane amount of money through insurance, buying the insurance and getting those profits, which, if you follow those companies, haven't been the most ethical. His train companies that he loves to buy, for some reason, were having a really hard time staying on the tracks and not creating oil fireballs, which was a bit nuts. And then finally, if you've heard it, they've talked about it pretty frequently in the news the past few years. He has some mobile home companies that sell mobile homes to people. It just almost mafia style loan rates. Basically the highest you can legally be. You're selling them a depreciating asset. They can't even get out of it. They'll think that their asset's $50,000, and then they'll end up owing $80,000 on it. Just some really shady stuff. Now, is Warren Buffett in control of all that? Like, is he the one at home at night twisting his mustache, writing his contracts? No, he isn't. But he bought these companies, and they've been running that way. So I don't like that. So that's kind of my views on Warren Buffett, but I do like some of his investing principles. And here's, if you take away one thing from Warren Buffett, it's this. It's 2 rules. Rule 1, don't lose money. Rule 2, see Rule 1. I mean, it's very, very straight to the point. Don't lose your money. You can't. That'll kill you in the long run. Losing large sums of money will hurt you more than making a higher return. You will come out vastly ahead if you make a steady, smaller return without large losses than you would if you have, I've got a large loss here and there, but then I make a higher return. That, and it'll probably be better for your blood pressure. Your doctor will thank you. So here's enough of me bashing Warren Buffett. And again, I actually, it sounds like I'm bashing him. I just want to give you my full view of him. I still think he's probably a good person, and it's not fair of me to ride him too hard, especially when I hear to defend himself, and he has done a lot of good. So moving on, one of the big questions is, how long does it take to compound out of a hole? So Michael Lebowitz here, he's the guy that wrote a lot of those articles I was talking about. He's got this website, Real Investment Advice, he and some other financial professionals. Phenomenal charts, phenomenal analysis. He calls out a lot of BS on other financial advisors, and it can be pretty entertaining. And we'll get to this tweet here on the next slide. But some takeaways. 2 of the major market corrections of over 50% in the last 2 decades. Not minor market corrections, over 50% in the last 2 decades. That's a pretty big correction. So when you see a 50% loss, how long does that take to recover from? It takes a while. And then buy and hold investors, while they're technically ahead, how many years did they spend getting back to even? And that's what his chart here is showing. And so let's go to the next page. Enhance. Oh, there we go. That's easier to read. A little larger. Again, Real Investment Advice is the website that he posts a lot of stuff on. He also did articles on Zero Hedge. Phenomenal stuff. Credit where it's due. I completely ripped off the Part 1 title from him. But anyways, let's get to what this chart actually illustrates here. So here is kind of where we're at. Here's our years. So now we're showing how long it took to break even since the last Great Recession. Took 14 years. So here we are. The decline came back up, declined a bunch more, and slowly been coming back up. 14 years to break even if you had kept all of your holdings from the beginning of the Great Recession till now. That's a long time. I mean, almost a decade and a half just to get back to where you were. And it is inflation adjusted, which is nice, because if it was literally just, you had $1,000 and now you're back to $1,000, then you lost a lot due to inflation. So this takes that into account. So 14 years. Let's look back here in the 70s. 24 years. Over 2 decades. I mean, that's 2/3 of my life. 3/4. 24 years to get back to breaking. And then we got some older, if you look back even further, almost 3 decades here. That's insane. Can you afford to have your money just getting back to breaking even for decades on end? The answer is you can't. Not if you want to have the type of retirement that most of us want and actually get ahead. At this point, with these big losses, you would have been better off just having your money under a mattress or in treasury bills or something else, just paying you a very nominal interest rate. If you could have just matched inflation at that point, you probably would have been ahead. So just something to think about. The recapture time is usually much longer than people take into account, and people don't think about it. So let's have a quick example, because a lot of people will use percentages when they're talking about their portfolio. So let's say you have $1,000 and you lose 50% in 1 year. The recession hits, it's terrible, you lose half of it, so you're down to $500. That following year, you have a great year, you get 50%, so you think you're back where you're at because 50% and 50% cancel out, right? No, because you had lost 50% of 1,000 and you gained 50% on half of that, so you're at 750. You're still $250 away from where you started, or 25%. So that's why people get really confused, because they're thinking percentage and they don't realize a percentage isn't the exact number. It's not you lost $50 one year and then gained $50 the next year. So you got to be very, very careful with that. So you're probably thinking to yourself, if this is known, why don't investors and investment professionals plan for this? Well, here's the deal. It should be known and it should be obvious, but it really isn't. And part of the problem is there's a huge lack of experience in the investment professional industry. Most of the people that are involved now haven't even been through a complete cycle, let alone 2 or 3. Some of them haven't even seen a recession. Maybe they saw it when they were finishing up school. They saw the Great Recession, but they haven't seen it. They haven't worked through it, and that's a huge deal. Then there's this stupid belief that it won't happen again. It's different this time. Everyone always acknowledges this, that that's a stupid belief, but then they'll go out and say, "Oh, it's different this time. It's not going to happen." Well, it technically is different, but that doesn't mean it's not going to repeat in some sort of fashion, whether it's good or bad. And then here's another big deal. It's extremely easy to be lazy, invest passively. Whether you're investing for yourself, but then if you have a professional investor on your behalf, yeah, they've got so many accounts and so much accounting that they have to do for that. It's so much easier for them just to put you in their investments, especially if they have mutual funds. They're going to generate great fees from putting you in there, because they're going to get the buy fee, they're going to get the sell fee, and they get management fees all on their own product. Generally, if you're going to use a professional to help you invest, you want them to be motivated to have them do well when you're doing well. So I would be very careful of investing in anything that generates fees based off of buying and selling, and their performance isn't based on your performance. If they're getting a percentage of what your overall account is worth, then they are motivated for your account to do well. That doesn't necessarily mean it's going to do well, but at least now the stars are aligned in the proper direction. And then here's another thing. It's really, really hard to go against the herd. It's funny, all these professionals talk about, oh, the herd's stupid and everything, yet they go along with it. So it's really hard to stand out there and say that the sky's falling when everyone else is in the Lego movie saying everything's awesome, and vice versa. It's very hard when blood is in the streets to be out there buying things up at very low prices, because you don't know when it's going to bottom. It's tough. It's really tough, especially if you're used to looking for some type of social proof or confirmation. So while I am dogging on investment professionals, I do recognize they have a very hard job. One, some of them just don't have the experience or the education. 2, a lot of them work for places where they just, hey, it's our stuff. You can't do anything to fancy or think outside the box. And then, the fear of ruining your reputation by going against the herd. And then the other problem is a lot of people aren't that savvy when it comes to investments. So everyone's heard of stock and bonds. They know that the big tech companies like Google and Apple, and they know that sexy stuff. So it can be harder to educate them and convince them to buy into other types of investments. Something that's maybe not as sexy, or they don't understand. Maybe it's some type of oil and gas royalties. Maybe it's just something boring like utility stocks and just collecting the dividends. So they do have an uphill battle. Now, I showed you the previous tweet all blown up. In fact, I'll even go back to it. So here it is, the enhanced version all blown up, where we were showing how the time to recapture loss, and here's the original, the tweet that Michael put out with his commentary. When this market does break, you may be waiting a long time to get your money back. Ignoring history, risk levels, and valuations has its consequences. So he wasn't necessarily calling anyone out specifically, but he was just putting out there that, hey, things aren't that great, and people need to be careful. And this was one of the first responses that he had to that tweet. He's like, well, now run it including dividends because price only doesn't apply over long periods of time, then consider the fact that a vast majority of investors add to their stock funds biweekly via retirement accounts rather than plunk down a lump sum at absolute peaks. So basically, what Downtown Josh Brown is saying here is there are other factors that should help with that. A lot of people are going to have what they call DACA. It's dollar cost averaging. And so they're not going to buy it. They may have $1,000 of a certain stock or fund, but they probably didn't buy, hey, here's $1,000, I'm buying it now and I'm done. They probably dollar cost averaged into it, especially through a lot of retirement accounts. They'll do that in a lot of brokerage accounts because people just like, oh, well, I'll put $50 into my brokerage account each paycheck and then I'll slowly have it buy more of Apple or whatever their favorite stock is. So it is a good point. There is dollar cost averaging, which can affect things because when you're at the peak and then it suddenly drops, yes, your stock's worth less than it was, but if you keep pouring money into it, you should get back to where you were sooner because, let's say the stock was at $100 and now it's at $10. Well, now you're basically getting a $90 discount to get back to where you're at. Hopefully that makes sense and I'm not oversimplifying it too much. So it was a very good point, and let's see what happens. There were some more tweets in there in the whole stream that were pretty snarky and condescending, so I titled this slide, Play Stupid Games, Win Stupid Prizes. They totally tried to call him out for his original post and his original graph, and so he did adjust it. He took total real return of $1,000 investments, he dollar cost averaged it in, and this is what happened. So still, 13 years, 12 years, 15 years, 6 years. So while it did significantly reduce the time in most cases, we still got 3 of these cases here where it's over a decade. So it's not like, oh, it completely nullifies it. It saves you some time, but it is not I wouldn't even call it a solution. It's just a byproduct that can kind of help if you're really committed to buying and holding and dollar costing your average way. It is definitely not a solution or a way to prevent large losses from buying and holding. We're just about done here. Let's just go over the key takeaways. Dividends and dollar cost averaging only shorten the time needed to break even. They do not prevent it or solve that problem. Most adults, we only have one full market cycle. Maybe it's from maybe it starts in a bull market or bear market, and then to get back to that point, most of us only have one market cycle to invest in and retire. Now, if you start really young, like I did at 16, you probably have 2, maybe even 3. But the majority of people really don't get to a good place financially to start saving for retirement until they're about 35. So, for me, that would be December this year is when I should start investing in retirement if I was going to be average. So, 35, and then, let's say you want to retire at 65, that's only about 30 years, 25 to 30 years to invest. And before you probably need to start taking out, unless you save up a bunch of other money or you have some type of pension system, most people are going to have to start withdrawing their retirement accounts pretty soon when they retire, because usually Social Security is not going to be enough to pay for everything. And it definitely won't in the future for my generation, because I doubt I'll even be there. Next takeaway, buy and hold investors fail to consider risk and other strategies. We've talked, I think we've beaten it to death now that buying and holding has a lot of risk there, because a major downturn eats up so much of your money and so much of your time to get back to break even. There are other strategies. We talked about briefly about how T-bills and some other lower risk strategies with secured assets may pay less, but over the long run, you can actually be better off because they won't have the big downturns. And here's another deal. Nobody generally is going to care about your financial future more than you, just like no one's going to care about you or your family or your kids more than you and possibly your family and some good friends. I try to treat my investors' money better than I treat my own and be very prudent, but at the end of the day, as much as I care about it, it is still their financial future, and I can't want that for them. If they don't help me paint a picture of where they want me to take them, I can only deal with what I know. And most people, financial professionals, while they do want you to do well, they're not out to maybe rob you. They just want to get paid at the end of the day. and their incentive for you to do well is basically just aligned with their payments. If they do well and get you more money, then they're probably going to make more money off of you. They'll get better bonuses. A lot of these financial professionals, they don't even meet customers or investors, so they're pretty detached. Again, doesn't mean that they're evil, that they're sitting at home twisting their mustache trying to figure out how to bilk investors. I don't think these people are unethical. It's a very realistic and I think fair statement to say that no one's going to care about your financial future more than you. And then finally, there are no perfect investment strategies, because a lot of times this would be the part where we'd go into, hey, but I've cracked the code. I've got the best investment. Give all your money to me and I'll make you a bunch of money without risk. That's not this. If you're looking for that, that's not this. I invest in notes and real estate, and that's what I like, and that's what I focus on. But it's not perfect. You can still lose money. There are lots of people that lose money in it. So there are no perfect investments. There are no sacred cows. You need to become educated on what you're investing in and the different options. And if you don't have the time or the interest to really learn about certain investments, then you need to find yourself a really good professional or professional team and that really knows their stuff. And you need to trust them. You need to really thoroughly vet them, make sure you trust them so they can handle that stuff on your behalf. Because again, this is your financial future. You don't want to work hard your whole life and then not really have anything to show for it. Take that into account. And all investments have risks. They really do. It's some less than others, but don't. If anyone tells you out there that there's no risk, don't believe them, because it's not true. So, sorry to get you all down in the dumps there. I hope you did enjoy this, though, even though it was a little bit disheartening as far as the stock market, and I beat that up pretty good. Hopefully you got some entertainment out and you at least learned something. Next week I should have another episode for you, and we'll have a new profit and other strategies to go over, what's good, what's bad. And I really thank you for your time, and don't hesitate to reach out to me with any questions or comments. Have a good week.